Hello and welcome back to everyone who's still here during the bear market year. Today I'm super excited to be making this video, as Bitcoin is currently fighting with one of the most important levels it has ever had, the 200-week moving average. This level has helped Bitcoin mark major support floors in past cycles, but as Bitcoin matures as an asset, is the 200-week moving average still enough, or do we need to look elsewhere? Currently, Bitcoin is trading roughly at its 200-week moving average. We can see in past cycles that the 200-week moving average has been key to determine the end of the bear markets during midterm years. Looking back at 2018, the 200-week moving average helped Bitcoin form a low before beginning its next cycle. Then, during the COVID-19 crash, Bitcoin closed its weekly wick at around the 200-week moving average before ending the 2019 bear market. However, it is important to note that the COVID-19 liquidation came down towards the region of the 300-week moving average, rather than just the 200 itself. And then in 2022, Bitcoin moved substantially beneath its 200-week moving average, with a final low forming around the 350-week. This marked around a 35% drop from the 200-week moving average, before Bitcoin found a substantial low in 2022. So, looking at this simply, we've seen major lows form at the 200-week in 2018, and had intra-week wicks stretch all the way down to the 300-week moving average in 2020, and then approximately formed a low at the 350-week in 2022. So, could this mean that in the 2026 bear market we could reach the 400-week moving average? Well, now I want to clear things up first. I do not think that we should focus on purely just the 400-week just because it comes next. We have a very few number of completed cycles to work from, so this could simply be coincidental and a random walk. A mathematical concept describing a path made of successive random steps that look real but are truly pure speculation. The COVID-19 crash was an exceptional market event. Rather than a bear market bottom, meaning we will never know where Bitcoin could and would have bottomed out if not for the pandemic crash. However, this does not mean that we should rule out the 400-week chimerical speculation. The first detail is the compression between Bitcoin's longer-term moving averages. As we have discussed before, Bitcoin's top was more apathetic than the past seen blow-off tops in earlier cycles. This means that we did not see the same level of euphoria, retail participation, or the same extreme separation between price and Bitcoin's longer-term valuation level. Mathematically, this gave longer-term moving averages a chance to catch up with price rather than being left behind, meaning that unlike in 2022 and 2018, Bitcoin would not need to go through the same kind of extreme collapse to reach the 350 and 400-week moving average bands. From the current level, if Bitcoin was to reach the 350-week moving average level, it would need roughly a 25% drop and a 32% drop to reach the 400-week moving average. This is obviously a significant move, but it is not completely unrealistic. However, more importantly, this type of move also applies confluence to our "is now the time to buy" valuation chart, where I previously stated that I would not be surprised if we reached the fire sale level. Now the 400-week moving average is not interesting simply because it's the next line on the chart, but because we can now see it beginning to overlap with other risk estimates of where Bitcoin would become deeply undervalued during this bear market. Now I think it's important that we look at momentum, and Bitcoin formed a 3-point bearish RSI divergence at the cycle top in 2025. Wouldn't it be poetic if the exact opposite happened at the cycle bottom? A lower price low, but a higher RSI low. If we look at the previous bull market, Bitcoin developed what I describe as a fairly clean 3-point bearish RSI divergence. Bitcoin continued printing higher highs throughout the later stages of the cycle, eventually topping in October of 2025. However, momentum failed to confirm those new highs. The first major RSI peak happened at the early stage of 2024 and reached almost 89. The second topped at the end of 24 at around 79, and by the final rally, RSI could only manage a reading of roughly 70. So although price continued appreciating, the underlying momentum was steadily deteriorating. That's a textbook bearish RSI divergence. Price continues making higher highs while RSI produces progressively lower highs, suggesting that the trend is becoming increasingly exhausted. Now, what if we were to see the inverse of that process during the final stages of this bear market? Imagine Bitcoin makes one final lower low later this year, but weekly RSI refuses to confirm it. Instead, RSI forms a higher low. Price would still be declining, but the momentum behind that decline would be weakening. Now I want to stress that the RSI divergences can be misleading. We can't treat them on their own. If a stock plummets or nukes, but prints a bullish divergence in the RSI, this doesn't alone mean that it can't nuke even more. But If a bullish RSI divergence were to develop at the same time as Bitcoin entered a major long-term valuation region, such as in between the 350 and 400 week moving average bands, and if the other valuation metrics also began converging towards the same area, then we'd have something considerably more compelling than a single technical indicator. At that point, we're no longer looking for one isolated signal, we're looking at confluence. So, what valuation levels would actually make me interested in deploying more capital? So where does the first major valuation region actually begin? For me, it starts around the 300 week moving average, which is currently sitting at roughly $55,000. From today's price, that would represent a decline of approximately 14%. Now on its own, that's just another moving average. There's nothing particularly special about it. But what makes this region interesting is it also sits relatively close to Bitcoin's realized price. If you've never come across the realized price before, it's essentially the average price at which every Bitcoin currently in circulation last moved on chain. In other words, it's a reasonable approximation of the market's aggregate cost basis. The current Bitcoin realized price sits around 22.4% beneath the current prices. Now, the realized price isn't just some magical level that Bitcoin has to respect, but when we look back through previous bear markets, one pattern becomes fairly obvious. Bitcoin has consistently revisited the realized price, and during every major bear market has eventually traded beneath it before establishing a meaningful cycle low. And that's because once Bitcoin falls below the realized price, the average holder is sitting on an unrealized loss. Historically, that's often when capitulation begins accelerating and long-term value starts becoming much more attractive. Now, does that mean Bitcoin has to revisit the realized price this cycle? Not necessarily. Markets do evolve. Institutional participation is significantly higher than it was in previous cycles, and that could change the way Bitcoin behaves in around these long-term valuation levels. But this is exactly why I focus on regions, not just individual price targets. The area between the 300 week moving average and the realized price forms the first major valuation zone I'll be watching. If Bitcoin finds support there and begins recovering, then the 400 week moving average may never come into play, and that's a perfectly plausible outcome. However, if Bitcoin decisively loses this realized region and begins spending time beneath it, then my attention shifts towards the next valuation region. Unlike the realized price, which estimates the average cost basis of the current Bitcoin supply, the balanced price attempts to identify the deeper stages of the bear market. Without diving too far into the maths behind it, it's derived from Bitcoin's on-chain data and historically acted as a valuation floor during periods of extreme market pessimism. At the time of recording, the balanced price sits at around $38,000. That's approximately 40% below the current market level. Now, what's interesting isn't just the level itself, but the history behind it. When we look back across the previous Bitcoin bear markets, price has constantly revisited the balanced price region before establishing a long-term cycle bottom. Now, that doesn't mean that Bitcoin has to reach it this cycle. Markets do evolve, and no valuation model should ever be treated as a prediction. In fact, I'd much rather see Bitcoin establish a higher low than revisit prices in the high 30,000s. But if markets were to deteriorate further, the balanced price gives us another independent reference point for where Bitcoin could begin looking deeply undervalued. And that's where things become particularly interesting, because just above the balanced price, we have the 350 week moving average currently sitting at around $48,500, followed by the 400 week moving average at approximately $43,000. So rather than viewing these as isolated indicators, I prefer to think of them as a cluster. 3 completely different valuation methods, all sitting within the relatively narrow price range. If Bitcoin were to trade somewhere within that region, after falling below the realized price, and momentum indicators such as the RSI beginning to show signs of exhaustion, that would represent the strongest area of confluence I've identified so far in this bear market. There is a major difference between this cycle and every Bitcoin cycle that came before it. The US spot ETFs. These funds have created a completely new source of institutional demand, but I don't think that means they have created a permanent floor beneath Bitcoin. We've seen similar development in other markets. Gold received its first major US-backed ETF in 2004, but it still suffered a decline of more than 30% during the financial crisis. Alongside this, silver received its ETF in 2006, but later fell by almost 60% during 2008. And Bitcoin's own futures ETF launched just weeks before the 2021 cycle top. So an ETF can make an asset easier to own, it can attract new capital, and it can strengthen demand over the long term, but it doesn't remove the cycle. So the distinction I think matters here is the difference between the total holdings and new flows. The ETFs have already held a significant amount of Bitcoin. That doesn't mean they are continuously adding to their positions. We can see recently that people like Strategy and Michael Saylor have started selling their Bitcoin for US reserves to pay off dividends. Markets move at the margin, so rather than focusing entirely on cumulative flows, I'm watching whether the new money is entering or leaving. And more importantly, I'm looking how Bitcoin responds to this. We can see since the top in 2025, many investors have panicked, and there's a lot of ETF outflows flowing out of Bitcoin. If ETF outflows continue, and Bitcoin continues falling aggressively, then institutional demand still isn't strong enough to absorb the selling. But if those outflows begin slowing, or if Bitcoin stops making proportionally lower prices despite continued redemptions, that would suggest the selling pressure was beginning to exhaust itself, and the dollar could help confirm that change. Now, unfortunately, I do not think it's all positive for the dollar. Looking at the weekly chart, the dollar appears to have established a base around the 96 to 97 region. Since then, it started producing higher lows and has recently reclaimed the psychologically important 100 level. That is not particularly constructive for Bitcoin or risk assets more broadly. A strengthening dollar generally represents tighter global financial conditions. Dollar-denominated funding becomes more expensive, liquidity is pulled towards the US, and investors tend to become less willing to hold higher risk assets. However, I don't think the chart has delivered a decisive signal yet. The Dixie is recovering, but is also approaching an important resistance region between roughly 101 and 102. This area has rejected the dollar several times over the past year, so the next move could be significant. If the Dixie can break above the region and begin holding it as support, that would suggest the dollar's medium-term uptrend is strengthening. Combined with the weakening ETF demand, that would only make Bitcoin's lower valuation regions increasingly plausible. It would not guarantee that Bitcoin reaches the 350 or 400 week moving average, but it would create a considerably less favourable environment for risk assets. On the other hand, if the Dixie is rejected from the region and falls back beneath the 100 level, then some of that pressure begins to ease. That could support renewed risk appetite and reduce the probability of Bitcoin reaching the deeper valuation levels discussed earlier. It is also worth remembering that the dollar does not have to collapse for Bitcoin to form a cycle low. Previous Bitcoin bottoms have developed under very different dollar conditions, so I'm not using a DXY to predict the exact bottom. I'm using it as a risk filter. A sustained breakout above 102 would increase the probability of further weakness, while a rejection and renewed dollar decline would create a more supportive backdrop for Bitcoin. So when I combine the two macro variables, the most negative scenario would be continued ETF outflows alongside a strengthening dollar. The most constructive scenario would be an ETF selling beginning to lose momentum at the same time as the DXY fails to break higher. Neither outcome tells us exactly where Bitcoin will bottom, but they can help us judge where the probability is shifting towards the shallow valuation region or towards the considerably deeper one. So, what does all of this actually mean for my portfolio? At the time of recording, the 30-day smooth risk score sits at 0.25. That still places Bitcoin within the relatively low risk region, although I believe we remain inside a temporary window of strength that could persist until the back end of July or potentially later into the summer. Beyond that, the balance of evidence still points towards the possibility of one final leg lower later this year. Now, I'm not claiming to know exactly where Bitcoin will bottom. I don't think trying to identify one precise place is particularly realistic. Instead, I use a broader valuation regions to understand where we are within the cycle and where the potential return justifies supplying more capital. If Bitcoin can remain above the 200-week moving average and follow a more time-based capitulation path, then I'm comfortable continuing to accumulate gradually, as long as my system continues to justify that allocation. In that scenario, price may not collapse dramatically. Instead, Bitcoin could spend extended period moving sideways, allowing valuation and momentum indicators to reset over time. However, if Bitcoin does make another significant move lower later this year, then the risk associated with deploying new capital begins to decrease. As price enters progressively stronger valuation regions, I can increase the size of my DCA accordingly. That said, I still bought more Bitcoin this week. I recognise that lower prices remain entirely possible later this year, but my system called for an allocation, and I think it's important that I remain consistent with the framework I've created. If I had been offered the opportunity 1 year ago to buy Bitcoin at the 200-week moving average, I would have taken it without hesitation. So it wouldn't make sense for me to abandon that strategy now because the market could move lower in the short term. That's the entire purpose of the dynamic risk-based DCA strategy. I'm not waiting for one perfect entry. I'm allocating capital gradually, with the size of each purchase determined by the level of risk within the market. If Bitcoin does fall further, That's not necessarily a negative outcome for my strategy. It would allow me to increase my purchases at a progressively stronger valuation. And Bitcoin never reaches those deeper levels, I'm already sufficiently exposed to benefit from a recovery. So heading into the second half of the year, I'll continue monitoring how Bitcoin behaves around these long-term valuation levels, whether ETF selling begins to weaken, or the dollar begins to strengthen, and whether the broader macro environment becomes more or less supportive. I don't need to predict the exact bottom, I simply need a framework that allows me to respond rationally as the evidence changes. And finally, as a wise man once said, trade the market you have in front of you, not the market you wish for. Thank you.